Hello, fellow investors, future millionaires, super savers. This video, China's economic crisis, CCP line to public, stock market crashing, business falling. China's biggest 100 companies are down 40% since its peak. I just was watching this video, and I like the way how they have this. It's similar to FinViz, kind of how they got it broken down, but they got it broken down into sectors.
It represents America's 500 most valuable public companies.
You can see Amazon, Tesla, McDonald's, Nike, Home Depot, Lowe's.
Investors, and this number is on the rise. Institutional investors are organizations like banks, mutual funds, pensions, or in the stock market is also fake. In 2019, over 50% of China's stocks were owned by institutional investors, and this number is on the rise. Institutional investors are organizations like banks, mutual funds, pensions, or insurance providers. They buy stocks to grow their capital. These kinds of investors also have a huge share of the United States stock market. But there's one key difference. In China, the CCP has a lot of influence over these institutions. Last year, Xi Jinping announced a new financial regulatory body called the National Financial Regulatory Administration. This organization centralizes the CCP's control over the financial sector. Basically, Xi Jinping wants the banks to put capital where the CCP needs it, putting it into free market times. By pouring capital into the stock market, the CCP is already artificially keeping the prices up to fight the market crash. According to the Swiss UBS Bank, Chinese-backed funds have already bought $57 billion worth of stocks this year. The CCP-owned China Investment Corporation plans to continue pumping up the prices on the market. But most importantly, all of these non-CCP banks...
You know, like, my stance on China is, you know, supposedly they're going to overtake the U.S. I don't believe that. You know, the U.S. is basically 30% of the world's GDP. I think the U.S. Economy is around 20 trillion annually. The bad news is that the U.S., you know, is called the Buffett indicator, where they basically just take the total capitalization of all the U.S. stocks as a percentage of the U.S. debt, and it's at 125%, whereas China is at 200% debt to GDP. Now that Chinese stocks are down 40%, I mean, this could be a buying opportunity. Tencent is down 60%, I believe. What I also like about this video is it talks about 70% of Chinese wealth is in real estate. But a lot of people were investing in these Ponzi schemes where they were robbing Peter to pay Paul. Basically, what they would do is you would pay for a home up front that's not even built yet, and instead of building your home, building your apartment complex, what they would do is they would buy more land, and before your place is even finished, they get another sucker to give them money. And then once they were exposed, a couple of years ago, and people stopped making their payments. And the Chinese economy is basically 30% real estate, but it's actually a lot higher than that, and I will tell you why. The reason that it is higher is because basically everything revolves around it. You need a truck driver to deliver the goods from point A to point B. You need construction workers. You need electricians. You need people to lay the cement. You need architects. You got salespeople. You need bankers to give you the money. So it is more than just 30%, because all these other industries are tied together. Well, this is a very long video. Well, I shouldn't say that. It's not long by my standards, because I like to ramble for a while. But
buy on blue, sell on red.
But there was some interesting things here that
way out of an economic downturn. The earnings of companies on the Chinese MSCI index fell for 4 straight quarters. Apple, which recently posted its first yearly increase in earnings, had one weak spot.
And this is one of the reasons why I do not like Apple. And I've talked about this before. I've watched a video in China that was made years ago where they were just stealing Samsung phones, selling them for $100 and plopping an Apple sticker on the back of it. Instead of paying $1,000 for an iPhone, they were just buying a Samsung phone for $100 and stealing the Apple insignia and plopping it on the back of it. But I might be wrong, but I think most of the factories are in China. And that could spell problems for Apple. And China as a whole, does not believe in individual property rights. That's another reason why I don't like Tesla, is because they're too focused in China. And anything, and basically all the big companies in China, they basically just copied U.S. companies. That they got a copycat for the Baidu or whatever. They got a copycat for Amazon. They got a copycat for Facebook. They got a copycat for this. They got a copycat for that. That's all they do is steal intellectual property. They never do anything on their own. They always steal someone else's idea. And if the factories and stuff for Apple, if the factories and stuff for Tesla are in China, they're going to steal your intellectual property, and they'll just make a copycat. And they'll slap the the government will buy that company, or the government will support that company, and they'll put money where they want to put it at, and they'll just make it a state-owned enterprise.
But the Chinese market, where the rest of the world had steady growth, Apple's revenue in
Minus 13%. And this is the, if the U.S. says 20% of the world's GDP, China is right behind at like 20%. And China is supposed to overtake the U.S. in a couple of years, which I don't see happening. And number one, I mean, the party is a communist party, and I don't really care what your religion is or whatever, but I'll tell you this, God might be in parts of China, but God is never going to bless a communist country, period. It's never going to happen. God is against communism. But I've talked about the U.S., how they started as agricultural economy, and only the men were working, and then they went into manufacturing, which was good for men, and then you had this women's revolution when you had women working, and as well, then you had two-income households, and now the U.S. is 60% services, which favors women. China is stuck in this manufacturing economy. And, I've talked about this. The demand for manufacturing, it might be 4%, but the productivity growth due to robots or better floor layout in the factories or ergonomics, whatever, is like 8%. So manufacturing jobs will go down just over time because people become more productive. There's new inventions. I've seen recently, part of the problem in Argentina is they've been stuck in an agricultural economy for 100 years. They never even got to a manufacturing economy. And now the rest of the world has evolved over the last 50 or 60 years that they couldn't even compete even if they wanted to.
China declined by 13%. In general, the Chinese economy has never really...
Another thing about China is they lie on everything. They lied about COVID. You can't trust. It's almost kind of like in this country where the Democratic Party owns 90% of the media outlets, and they can use that power to for propaganda purposes. But in China, they'll shoot you. They'll put your family in jail if you say something bad about the president. You say something bad about a company, they'll shoot you or put you in jail, and put your whole family in jail, and never hear from you again.
recovered from the COVID pandemic. Other nations have seen a rebound since the lockdowns due to huge stimulus programs. Consumer spending increased so much that there was even an inflationary crisis all over the world. But in China,
I paid for this ad to be in.
it happened. It's now in a crisis of deflation. That may sound unfamiliar to many, because the United States last experienced deflation back in 2007 and 2008. It is the opposite of inflation.
I forgot the guy's name, Dr. Lacey Hunt. I'll have to do a video on him, another one, but that's what he was actually predicting that would happen in the U.S. Deflation. Which means instead of prices going up, they actually go down.
Meaning that prices go down over time. This may sound nice for the consumers, but it's terrible for the economy. Consumers will delay their purchases, meaning that revenues of companies will go down. Let's say you've been saving up to buy a new car. If you know the price is going to drop in the future, you may decide to just wait a while. But if everybody does this, car dealers and manufacturers have a big problem. This applies for every other industry as well. And as a result, the entire economy slows with rising unemployment and declining investments. For China, this is a real risk, as deflation is increasing at alarming speeds. In January of 2024, consumer prices in China declined at their fastest pace in 14 years. But actually, this isn't what's plaguing the Chinese economy the most. If we dig a little deeper, we find another core problem. The deflation is related to something called the debt deflation spiral. Because of problems in China's financial industry, credit is drying up. This is the root cause for the decline in spending, and in turn, the increase in deflation. And as the financial sector and spending are related to the stock market, these problems also lay the basis for the stock market's collapse. So let's dive a little deeper into what's happening with this debt deflation spiral, shall we? Now, you may think that the debt problem in the United States is getting pretty bad, but then you haven't seen what's happening in China.
But one thing I'd like to add is, banks basically create money out of thin air. And the way they do this is, when you put your money in a bank, I've said this many times, you put $100 in the bank, well, they only have to keep 10% or $10 of your $100 in the bank. And then the other $90, they can loan it out, have people pay 30% interest rates on a credit card, have people pay 7% on house, 4% on car loans, whatever. They're making money off of your money, and you're not getting anything in return. They're making money off of you, so that's why they want you to put their money in their bank, so they can loan your money out and charge interest on it. And when the U.S. government is money printing, and I don't know. I'll get back to the video. I'll shut up.
Washington holds about 120% of its GDP in government debt.
This was I was talking about the Buffett indicator, which is basically you take the government. Well, this is government debt, so you could split it into government versus private. I'm not sure I can't remember exactly what the Buffett indicator was, but I want to say it's total debt, So if you took even total debt, it'd be a lot even higher than this. Let me see. Buffett indicators market cap to GDP ratio. Value of all public stocks in the country divided by the gross domestic product. I'm not sure when this thing was updated. So, I mean, if you're looking at this is a horrible time to be buying stocks. You know, the current PE is 33.7. So you can look over history. And it's talking about standard deviations and shit. But up here it was way almost 3 standard deviations away. But, you know, anything down here would have been the time to buy. You know, this environment is very difficult to it be an investor, because I mean it's an everything bubble. Everything is in a bubble. So you got to look for things that are not in bubbles and things that are terrible around the world. You know, things are terrible in Argentina right now. Things are terrible in China. They're not terrible in the U.S. yet, but could be coming. You know, silver is low. Oil is low compared to its all-time highs. You know, you can look at other commodities or what have you, but this is just U.S. government debt as a percentage. Whereas if you're looking at the total stock market value over GDP, I said 20 trillion. They got it as 28. 193, and it might even be worse than that.
In China, this debt to GDP ratio is a whopping 280%. It's not the government in Beijing that issued.
Well, I thought China was at 200, so if they're closer to 300, that's even worse.
These debts, as the central government holds only 1/14 of the debt pile. The bulk of it is held by local governments. During the last 15 years, they founded many local government financial vehicles called LGFVs. These are local government enterprises that prop up the economy. In 2022, there were almost 3,000 of them. They held about 80 trillion yuan, or $11 trillion, in debts. To put that into perspective, we're talking about approximately half of China's GDP in liabilities. In total, state-owned enterprises held 2/3 of corporate debt. More than 60% of this debt was in the form of bank loans. The problem is that most of these LGFVs aren't able to repay their loans. A third of them don't have a positive cash flow, and 60% struggle to pay their interest with their own earnings. Without support from the local governments, many of these companies wouldn't have existed in the first place. So this begs the question, how much of China...
Listen, there's never been a more important time in
Another problem is the huge bubble of non-performing loans that this has created. After all, who's going to pay for the $11 trillion in debt? Last year, Xi Jinping ordered state banks to restructure LGFV debts at lower interest rates. But of course, he has a price to pay for this. All of these bad loans hurt the Chinese economy because there's less capital to invest in actually profitable businesses. The same is true when we look at its real estate crisis. Over the last few years, China's real estate sector has turned into a huge debt bubble. This is a big deal, as Chinese property is the single biggest asset class in the world. It's gotten so bad that the CCP is pushing banks to provide $446 billion to property developers. 50 of them are on the brink of financial collapse, including infamous companies like Country Garden. They've run huge Ponzi schemes which came crashing down from 2020 onwards. Basically, the developers bought land and sold houses that they haven't built yet. With the money they received, they bought more land and then just did exactly the same thing. In 2019 and 2020, 90% of properties were sold with this pre-sale model. This led to huge liabilities on the developer side, with Country Garden and Evergrande holding more than $500 billion of them. This was made possible by corruption, but also because local governments needed to meet GDP goals. At its peak, the real estate market made up 25%.
And I've said this before, I'll say it again. The reason why, let's say, we've averaged 10% for the S&P 500 has been, let's say you own Coca-Cola, for example. Coca-Cola pays a 3% dividend, right? That's 3%. And this is why stocks always outperform bonds, and why bonds are typically a horrible investment, is with a bond, you're capped as to what you can get. If it's 4%, it's 4%. If it's 3%, it's 3%. If it's 1%, it's 1%. Yeah, you could make money if you buy like BND or TLT or whatever, and you buy when it's low and sell when it's high, or vice versa, or whatever. But typically, your interest rate is whatever is printed on the bond. And what Buffett used to say was, you basically want to take a stock and turn it into a bond. But instead of 3%, you want to be getting 20%, 10%, 12%, 15%. But to get to the 10%, basically you take like a 3%, like Coca-Cola, for example, a dividend. Inflation's usually 2% in the USA, historically. That gets you to 5%. And then world GDP growth is usually 5%. So when you own a stock, you basically are getting 8% basically for free. You're getting world GDP growth for free. You're getting inflation for free. But I do not think that that's going to be true going forward in the next 10 years or so, probably because, like they just said, China is having deflation. So instead of, if you got deflation, instead of, getting an extra 2% on your stocks because of inflation, there's actually a 2% penalty on your stocks. And instead of 5%, the world's GDP growth is not 5% positive, but instead is only 2%. In this example, you're going to get a 3% dividend. You're going to get -2 from GDP. That brings you down to 1. And then world GDP growth might be at 2. So 1 plus 2 is 3. So instead of a 10% return, you might be getting a 3%.
5 to 30% of GDP. Because it was one of the key drivers of growth, local government.
But like I said, that with China, even though real estate is 20 to 30% of GDP, is actually probably closer to 60%, because like I said, you got banks that have to lend the money. You got lawyers. You got truck drivers. You got construction workers. You got people that do glass, people that do the plumbing, people that do the insulation. You got painters, electrical work. Once these hotels are up and functional, you got security, you got office people, you got people that answer the phones. I mean, they give jobs to so many different industries, and they're all connected. And you got 70% of all Chinese wealth in the real estate sector. But the sector is actually probably at least double. It's probably at least 60% of their economy.
Governments turned a blind eye to the Ponzi schemes. And initially, people weren't worried about the possible debt bubble. There was incredible demand for housing, and people thought prices would only go up. In early 2019,
and this is the same thing that's true today. I mean, it's tulip mania all over again. You got Bitcoin mania, you got Dogecoin mania, you got. I mean, it's just crazy, and people think, oh, it's just going to keep going up. A house is just going to keep going up in value. Well, let's look and see what happened in China.
The price for a new house increased more than 10% year on year.
How high is the interest rate for the...
And what I liked about that one guy that I used to watch and learned a lot, Tony Dent or whatever his name was, or Tony something. I think I made a video on him. He was he lived like in the Swiss Alps or something, but and he was always talking about scarcity. But instead of what can go right, you want to know what can go wrong with a company. And if you're buying real estate right here, thinking, oh, it's just going to go up 20 or 30%, and then here you've taken a 80% loss. Now down here you lost 110%.
Percent of Chinese household wealth was stored in real estate, and buying a house was very popular. The developers thought that their debts were no big deal, as housing sales would just continue. But now, the sector is in turmoil. The recent collapse of the property giant Evergrande shows that the real estate boom didn't last forever. In 2020, the CCP
And just to remind you guys that Evergrande was the biggest real estate company. This wasn't just like a little mom and pop went bankrupt. This was the biggest.
intervened to stop the debt bubble from growing. It limited the pre-sale housing model, and banks stopped financing the property developers. Together with a slowdown in housing sales, this was the last straw. In 2021, Evergrande began to miss interest payments on $300 billion of its debts. After a period of battles with debt holders, Evergrande was finally liquidated earlier this year. Many fear that other property developers will follow in its footsteps. Now, you may be asking yourself what the local government...
But back when the U.S. economy crashed, and I'm talking Great Depression crash, I can't remember if it was Black Monday, Black Tuesday, whatever it's called, but when the U.S. market collapsed, there was one guy, and this was it back in one of the books I read, that, and this was when, now there's 15,000 or 16,000 companies, I think, in the U.S. or so publicly traded. I don't even know what the number is worldwide, but back then there might only have been 50 or 60 companies, that people knew about, and maybe more than that. But this one guy, he made millions of dollars just because he bought like 100 shares or 1,000 shares or whatever of every single bankrupt company in America, and a lot of them did go bankrupt, but the ones that survived did so well that more than made up for the ones that did go bankrupt. And I just mentioned that in passing just because it's possible to make a lot of money if you're investing. Say you invest in one of these Chinese companies that, not Evergrande, but maybe one of the other ones that goes bankrupt, and lo and behold, they end up surviving somehow. Even Tesla was like 1 or 2 days from going bankrupt before the pandemic, and they managed to survive. And not only that, the guy became the richest guy in the world. That's just amazing to me. You're like a couple days from going bankrupt, and then a couple years later, you're the richest man in the world. But you can make a lot of money if you invest and take a stab maybe at some of these Chinese developers that are trading for pennies on the dollar, and maybe they stick around. Maybe they survive, so that could be an opportunity.
Governments and property developers have to do with the stock market. But in fact, the LGFV and real estate crisis are some of the biggest reasons for the collapse. First of all, we have to look at the financial sector. China's economic growth of the past decades has been fueled by lending, which allows massive investments into businesses and infrastructure. And not just a little bit. In China, investment makes up 42% of GDP, which is heavily dependent on credit. Between 2007 and 2016, China's credit grew 18.1% annually, faster than the economy itself. Right now, China's financial system holds $53 trillion in assets, more than half.
And the other reason I think China's in trouble is demographics. I mean, they had that one-child policy, and it takes every family, a man and a wife, to have 2 children to replace themselves. And if you're only having males, because they got rid of the females, because they wanted to carry on the family name, so they got all these single men with nobody to marry. But even now, even after they've taken away the one-child policy, the people are not getting married, they're not having births, they're not having children. And soon you're going to have a lot of old people in China, because remember, every year the U.S. gets 1 year older, China gets 2 years older. And let me see something real quick. $38.5. Now I'm going to say China's going to be 40. And this is a little outdated. But like I said, for every 1 year the US ages, China ages 2 more. So the average age in China now is 40.
Half of the size of the world economy. To put that in comparison, US banks only hold $30 trillion in assets. So the credit growth caused the pile of assets in China's banks to balloon. But this Chinese credit machine is coming to an end. Chinese banks have to deal with a massive increase in non-performing.
I get paid $25 an hour working from home.
Basically money that they've lent and they're not getting back. Some analysts say that it ranges in the trillions of dollars, although the official figures are much lower. The insane amount of borrowing has backfired, because many loans weren't really even viable in the first place. Apart from raising the risk of bank insolvencies, this also means that overall spending will slow as credit dries up. The bad debts show that China's financial system can't keep expanding forever. We can already see this in China's outside investments. But as you can see on this chart from Boston University, it looks like China's Belt and Road Initiative funds have fallen off a cliff. Many of the $1 trillion already planned projects have also been canceled. The same happened with China's holdings of US debts, which dropped 40% to a 14-year low. This all shows that Chinese funds and banks need the money at home. What's even worse is that this financial turmoil results in deflation. Banks giving out less loans means there's less money available. Using basic supply and demand economics, this causes prices to go down. But there's a catch. This can spiral out of control. During a period of deflation, the real value of debt increases because the value of money goes up. In simpler terms, businesses with debt carry a load that just keeps on getting heavier. Eventually, this can lead to the collapse of these businesses because it's hard to stay afloat with that much weight on top of you. In turn, this leads to even more non-performing loans, less lending by banks, and more deflation. The stock market is anticipating something like this because it thinks that the Chinese economy is heading for a debt deflation loop. It's like a domino effect. One problem leads to another, and the whole market feels the impact. Before talking about the next effect, I need to ask for something. Because bad news about China's economy often gets censored, well, the more expensive the companies are, and the more trust there is in the future. After all, you only pay a higher price if you think the businesses are about to grow. When the price-to-earnings ratios go down, well, it's the exact opposite. People think growth is coming to an end, and they pay lower prices for companies. That's exactly what happened in China, as we can see on this chart from JP Morgan. In 2021, the price-to-earnings ratios peaked at 19, so stocks were 19 times their underlying earnings. At the start of 2024, however, the stock prices were only 9 times their underlying earnings. So the price-to-earnings ratios were down more than 50%. In other words, trust in the future.
So to me, this could be, like I said, I typically do not like China. Got nothing against the Chinese people. I just don't like the Communist Party. But this could be a buying opportunity. Chinese stocks are definitely lower than U.S. stocks.
Was cut in half. We can see the same development in the price-to-book ratio. This is the price of companies compared to their book value, the money they're worth if they sell off all their assets. You can think of this as their net worth. In the United States, stocks are worth 4 to 5 times as much as their book values. That means companies are expected to grow in value and not go bankrupt. In China, however, the price-to-book ratio is only 1.7. dropping to a 5-year low. So the data are clear. People don't have confidence in Chinese businesses anymore. This is also true for foreign investors. For years, banks and investment funds invested a lot of capital into the Chinese economy because of its growth miracle. In 2021, foreign direct investment peaked at more than $300 billion. But now the country has the first outflow of foreign direct investment in 25 years. As you can see on this chart, it reached negative $11.8 billion in the third quarter of 2023. Last January, the outflow in the stock market reached more than $2 billion. This is the longest and strongest outflow of foreign capital since 2014. The debt deflation spiral is obviously one of the biggest reasons for the lack of confidence. But we also have to talk about the 418.
I paid for this ad to be in front.
Was hurting the American economy. In the following trade war, the United States and China increased tariffs on hundreds of billions of dollars worth of trade. US President Joe Biden left the tariffs on $350 billion worth of Chinese full. Millions of Chinese moved from rural areas to the cities, and real wages exploded, as you can see on this chart. Although the CCP still
I don't really know how to read this thing. I believe, and this might be in their currency, but as far as I know, the GDP of China is 10,000 per person compared to 60,000 in the U.S.
and real wages exploded, as you can see on this chart. Although the CCP still likes to classify China's economy as developing, it's really a developed one already. GDP growth was in the double digits for years, and China has risen on the global economic leaderboard. Where it was the 7th biggest in real GDP in 1980, it quickly became second, overtaking Japan. It went from a GDP of $396 billion to almost $20 trillion, a 50-fold increase. The reason for this was quite simple. China had something to offer the world's free markets. It had an abundance of cheap labor, so could outcompete anyone in the field of manufacturing. Although the Chinese government was still communist in name, it increasingly adopted capitalist ideas. The Shanghai Stock Exchange, which was first opened in 1866, was reopened in 1990. In 1993, the CCP went as far as to amend its constitution and to create a socialist market economy system. It's basically capitalism with a lot of wiggle room for government influence. This marked the end of China's Maoist period, with the disastrous Great Leap Forward and Cultural Revolution. But when Xi Jinping rose to power in 2013, things started to change. Where his predecessors liberalized and decentralized the country, he did the exact opposite. By removing the term limits for the presidency in 2018, Xi Jinping has practically become China's supreme leader for life. This has also had its effects on the economy. Xi sees the free market economy as a huge threat to his power, which is why he may be ending the capitalist experiment. He doesn't see the private sector as something on its own.
Alright guys, anyway, thanks for watching.